Okay, well, hi everyone. Many thanks to the organizers for putting our paper in the program. This is joint work with two of my colleagues at the Cleveland Fed at Knotek and James Mitchell, as well as Mathieu Pedemonte from the IDB and Taylor Shiroff, who is a PhD student at Duke. And the usual disclaimer that this will be our own views applies. Okay, the starting point for this paper is the idea that the strength of the transmission of monetary policy really depends on consumers or people's, generally speaking, awareness of monetary policy changes, which eventually begs the question of, well, what determines the attention of consumers to monetary policy? Now, taking a step back, with the rise of inflation in the post-pandemic period in the US, Europe, and elsewhere, lots of attention was dedicated to attention about inflation itself. Very insightful papers were written documenting characteristics of consumers' attention to inflation. And so from there, one could possibly think that knowing how consumers' attention to inflation behaves, maybe we can draw conclusions from there to consumers' attention to monetary policy. However, attention to inflation is not the same thing as attention to monetary policy, as some recent research has shown. And so it would really mean that we would have to take a giant leap to say something credible about attention to monetary policy. So the bottom line here is that very little to nothing is known about, first, what type of consumers tend to be attentive to monetary policy, and second, what are the determinants of that attention, and that is exactly what our paper is after. To that end, we noticed a couple of very striking patterns in the Cleveland Fed daily survey. What you're looking at here is the evolution of consumers' attention to monetary policy around FOMC meetings, specifically 21 days before an FOMC meeting and 21 days after an FOMC meeting, with the vertical dashed line indicating the day of the meeting. In red, we're plotting the evolution of consumers' attention for those that report to have plans of making a big-ticket purchase in the next month, such as housing in the left panel and the vehicle in the right panel. We'll be referring to these types of consumers as having skin in the game. And in blue, we're showing the evolution of attention to monetary policy of those consumers that do not have skin in the game. And there's two patterns that really jump out of this figure. The first one is that consumers that have skin in the game, they're nearly twice as likely to be attentive to monetary policy compared to others. And second, around FOMC meetings, the attention of consumers with skin in the game is pretty much stable, whereas the attention of consumers without skin in the game really tends to jump up right after an FOMC meeting. And so if we were to see any cyclical behavior of attention around FOMC meetings, that would be majorly driven by consumers that have no skin in the game. And so what we're going to do in this paper, apart from documenting the behavior of consumers' attention to monetary policy, we're also going to try to rationalize the mechanism behind what we're seeing in this figure. So what do we do? Our paper is going to offer what we think is the first explicit measure of consumers' attention to monetary policy in the US. We'll be relying on over 170,000 observations spanning a time period from 2020 to 2025. We'll be using a rational inattention framework to derive a number of testable predictions for what drives attention to monetary policy. In particular, we'll be highlighting individual drivers of attention, specifically the skin in the game and individual level information acquiring costs, aggregate drivers of attention that would be new supply, think of it as being a proxy for the aggregate cost of acquiring information, as well as volatility of interest rates, and crucially, the interaction between the two, which will tell us something about the cyclical behavior of attention to monetary policy. We'll have all of these predictions validated, and finally, using this rational inattention framework, we'll try to say something about monetary policy communication implications. And in particular, what our framework is going to imply is that if we want to communicate, right, if policymakers want to communicate, it's optimal to do so strategically by focusing primarily on the consumers that have sufficiently high skin in the game and prioritize high volatility periods. Okay. In the interest of time, I'll skip the related literature, but there's many people in this audience that have made contributions, and jump immediately to the model. So the framework is relatively simple. we're going to think that consumers, they do not observe the real interest rate perfectly. We can talk about the rationale for why we went that route. The setup is pretty standard to a certain extent. These consumers are going to solve a standard consumption borrowing problem, with the key friction being that they do not observe the real interest rate perfectly each period. Okay, so in the first part, what these consumers are doing, they're basically maximizing utility subject to some budget constraint. The key parameter here at the individual level is what we're calling here AI, the absolute value of AI, which is for us the skin in the game. It is the absolute value of net borrowing relative to consumption in steady state. Think of a larger absolute value of AI, implying that this consumer has eventually higher skin in the game, but also it means that their consumption is more sensitive to changes in the real interest rate. For simplicity, we'll assume that income is perfectly observed, and in log deviations from steady state is just IID normally distributed. Now, the consumers, they don't see the real interest rate perfectly. For simplicity, again, we'll just think that the real interest rate is normally distributed with mean 0, uncorrelated over time. But eventually, what they do know is the asymptotic distribution of the real interest rate, right? So they know that the real interest rate is centered at 0, and it has some variance sigma r squared. Each period, each consumer is going to receive a noisy signal around the real interest rate, and the noise of that signal they're going to choose optimally. Okay, now eventually I know the sigma r squared for free. I'll gain something if I can make that, if I can get some more precise information about the real interest rate. I can do so by paying a unit cost of information, lambda I, to reduce the variance of the noise. Eventually, we need to define information flow. We're just going to use Sims 2003 entropy-based information flow with the function defined at the end of the slide. Okay, so how do we get then to the optimal attention? At the first step, consumers are going to solve for their optimal consumption decisions, and then given the budget constraint and their optimal consumption, they'll derive eventually their optimal borrowing and saving decision. And from there, they're going to choose their attention level, which is nothing more but really choosing the noise of the signal that they want to receive about the real interest rate, so that they are minimizing the present discounted value of the welfare losses that are coming from the fact that they cannot observe the real interest rate with certainty. So there is some uncertainty that's entering here, plus the cost of acquiring information. Okay. Solving for this problem will lend us to the optimal level of attention, which is defined in this proposition. And so here you can see that not everybody is optimally attentive. In fact, the optimal attentive consumers will be the ones that have sufficiently high skin in the game. The others, on the other hand, they optimally choose to be inattentive, right? They don't have as much skin in the game to pay off for the cost that they need to pay in order to get a more precise signal about the real interest rate. Among the ones that are attentive, right, attention is going to vary quite a bit depending on the information acquiring cost, depending on the skin in the game, as well as the variance of the real interest rate. Okay. Just to visualize things a little bit, what we're showing here is the optimal attention frontier. In the y-axis, we have attention. In the x-axis, we have the skin in the game. Focusing first on the black line, right? What becomes clear is that first, not everybody is willing to be attentive to monetary policy, right? But only consumers that have a sufficiently high level of skin in the game. And then once we're past that threshold, eventually the more skin in the game I have, the more willing I am to be attentive to monetary policy. Interestingly, eventually, if I increase the volatility of the real interest rate, that whole frontier is going to shift upwards. Okay? But it's really the high skin in the game consumers that will be remaining, attentive. And the most of the difference in the attention level after I increase the interest rate volatility will be coming from the individuals that have relatively low skin in the game, right? And so the high skin in the game consumers, they maintain high attention regardless of these external factors, just like we saw in the very opening figure of the presentation. So this framework, we're going to use it to derive a number of testable implications at the individual level. What this rational inattention framework says is that we should anticipate higher attention levels for consumers that have higher skin in the game and for consumers that face lower information acquiring costs. At the aggregate level, we should anticipate higher attention to monetary policy whenever information costs are generally lower. You can think of times that there's lots of supply of news about monetary policy, as well as higher attention when interest rate volatility is higher. And finally, there's interactions, right, between individual and aggregate factors so that the marginal effect of new supply and of interest rate volatility declines with the skin in the game. And it's especially these interaction terms that are going to rationalize the cyclical behavior of attention around FOMC meetings. Okay, so taking now this framework to the data, once again, the goal is to test all of those predictions. So if we were to think of a general regression specification, that would be the regression given here on the slide. In the left-hand side, we have attention to monetary policy, and we want to understand how a particular predictor is affecting that attention. What are the predictors of interest here? That would be the skin in the game, individual and aggregate information acquiring costs, as well as interest rate volatility. So what I'm left to show you in particular is how are we measuring then attention to monetary policy and skin in the game. Okay, so the data will be coming from the Cleveland Fed daily survey. As I mentioned earlier, we'll be relying on over 170,000 data observations spanning 2020 to 2025. The attention to monetary policy will be a binary response, so everybody is encoded with a 0 or a 1. The skin in the game will be captured by consumers' plans to make a big ticket purchase, like a home or a vehicle. For the individual, information acquiring costs will be relying on their education as a proxy as well as numerical literacy. At the aggregate level, we'll be measuring as a proxy of the aggregate cost of acquiring information. We'll be using news supply. This would basically be article counts that talk about monetary policy or the Federal Reserve in the US. And interest rate volatility will be measured by the 30-day standard deviation of the 1-year Treasury yield. Okay, attention to monetary policy. So we've been asking consumers whether they have heard any news about monetary policy or the Federal Reserve in the last week. And the figure here is plotting the share of respondents that report that they have heard news about monetary policy over the last week. And so there's a few things to note here. First, generally speaking, consumers are pretty inattentive to monetary policy. The highest level of attention that we ever got was close to 50%, and that was really a rarity. Attention to monetary policy also rose at a time when inflation surged, but also this was a time that the federal funds rate was lifted away from the zero lower bound. The other thing to note here is that there is also the cyclical behavior around FOMC meeting. The vertical dashed lines, they're indicating FOMC meetings, and so there is this tendency of attention to really spike right after an FOMC meeting, decline, and then spike back up again close to another FOMC meeting. Our measure of the skin in the game is coming from making use of two survey questions. First, we ask consumers whether they plan to purchase a home in the next month or year. These are separate from each other, right? So the month is a separate question from the year. And whether they plan to purchase a motor vehicle in the next month or year. Again, here consumers are encoded with a 0 if they say no, and a 1 otherwise. So the skin in the game, you can think of it as being measured on the extensive margin. Okay. What do the data say? So these would be implications 1 through 4. The standard predictions, they're validated. Consumers that have skin in the game, they are more attentive to monetary policy. Consumers that have higher education, they're more mathematically or financially literate, they're also more likely to be attentive to monetary policy. Whenever there's more monetary policy supply of news out there, attention is also higher. And whenever the volatility of interest rates is higher, attention to monetary policy increases. Now, all of these implications, right, they do confirm the rational inattention framework, but it's really the interaction between the aggregate and the individual factors that will tell us something about the cyclical behavior of attention. And so what we do next is try to understand how the skin in the game is affecting the pass-through of information acquiring costs to attention. And so what we're interested in here is this red beta coefficient. And theories suggest that that has to be negative, meaning that the effect of a rise in the new supply on attention has to be smaller for consumers that have skin in the game compared to others, which is indeed the case. And the similar finding it emerges when we look at the interaction between the skin in the game and the volatility or the standard deviation of the interest rate. Right? So the marginal effect of a change in the interest rate standard deviation is smaller for consumers with skin in the game compared to others. Right? So all of these external factors that would affect attention, they have more of a bite on consumers that have low or no skin in the game in our context compared to others. So going back then to that empirical pattern in the very opening figure in the presentation, right? Why the blue attention spikes but the red doesn't right after an FOMC meeting, the mechanism can be really seen in this figure showing the frontier of optimal endogenous attention to monetary policy. So the low skin in the game consumers, they're really part of the steep frontier of attention. And so when there is a change in external factors, such as a rise in the interest rate volatility, their attention really jumps up. And then the high skin in the game consumers, they're the ones that are in the very flat part of the black curve here. And so whenever there's an external factor changing, their attention rises a little bit, but the increase is not nearly as high as it is for the low skin in the game consumers. Okay, and so having validated then our rational inattention model that attention to monetary policy, it's endogenous, consumers, they choose it optimally. Then we wanted to think a little bit about what this means for central bank communication and the monetary policy transmission mechanism. So in this exercise of optimal communication, the way that we're going to think about this is, let's assume that everybody faces the same cost of acquiring information, lambda. And policymakers, they can choose optimally to lower that information acquiring costs for consumers such that they equalize the marginal cost of communication with the marginal welfare benefit. So here, the idea is that policymakers, right, they can communicate, but reaching to the very, to every single consumer, it doesn't come for free. You need to hire extra resources, engage with the public. There's costs that come with it. And so trying to balance that trade-off will pin down an optimal information acquiring cost from the point of view of the policymaker that will be denoting as lambda p star. Now, the lambda p star, once we pin that down, that is also, together with the structure of the communication costs, which I'll remain silent on during this presentation, they're going to determine what I'm calling here a communication threshold in terms of the skin in the game. Or in other words, it's going to determine what types of consumers identified by their skin in the game do I want to communicate with. The outcome of that exercise is that it's optimal to communicate or to target communication towards consumers that have sufficiently high skin in the game. Okay? In the context of our empirical evidence where the skin in the game is really tied to consumers that have plans of making a big ticket purchase like a home or a vehicle, that would be the home buyers and car buyers, but you can think of this skin in the game applying more broadly than this. Why does it make sense to focus on those types of consumers? Well, because the welfare benefit of doing so exceeds the cost of communicating. For the rest of the consumers, right, there are not enough incentives for policymakers to communicate to for different reasons. What I'm calling here the moderate skin in the game consumers, they're part of them, they're already being attentive to monetary policy, but their welfare losses from inattention are not that high, and so you end up with a situation where the welfare benefit does not exceed the cost of communicating on the part of policymakers. And finally, you have the low skin in the game consumers, which you shouldn't communicate with, because to begin with, they're optimally choosing to be inattentive to monetary policy. And my favorite example here is the consumers that are hand to mouth, right? They're just consuming whatever is given to them. They don't really care about smoothing consumption. They just consume their income. And so from the point of view of the policymakers, right, there's no welfare benefits to be reaped out of that. But on the other hand, you will be facing the costs of reaching to the hand-to-mouth consumer. I also wanted to highlight that there would be two channels of impact from communication. If, generally speaking, the structure of communication costs is so that you're facing low marginal costs of communication, that brings in the extra benefits that you will be bringing in new consumers past the attention threshold. So that's a case where monetary policy communication would be effective both on the extensive and on the intensive margin. But if, generally speaking, there's high costs of communicating with the public or with consumers, all that the policy communication can do is really affect things on the intensive margin, right? So you're just increasing the attention levels of the already attentive consumers. Aggregate attention is important because it determines policy transmission. So if you were to compute in our very simple model the response of aggregate consumption to a change in the real interest rate, that would be determined really by what I'm calling here KP, which is the aggregate level of attention in a world with communication under monetary policy communication. And so the implications then would be that communication, it does amplify the transmission of monetary policy, here defined as changes in the real interest rate on aggregate consumption. And we also show in the paper that if policymakers had to choose between low volatility versus high volatility periods when to communicate, the implications of our framework are that you should prioritize high volatility periods because that's the time that you can get the most out of communication in terms of attention. And so to conclude, what we're after in this paper is really try to understand better consumers' attention to monetary policy, what types of consumers tend to be attentive, and what drives that attention to monetary policy. Our contribution is to provide the first individual level measure of monetary policy attention, combined with a validated rationale in attention framework, and show that attention is really incentive-driven, and that there is evidence of a cyclical behavior of attention around FOMC meeting. And to finalize, the policy takeaway is that optimally, policy communication should not be universal, but it should be targeted towards individuals that have sufficiently high skin in the game, and ideally at times of high interest rate volatility. And with that, I'll conclude, and I look forward to your comments.
Thank you very much. So Michael, go ahead for discussing this paper.
Okay, well, while the slides come up, here they are. Let me say, look, this is a great paper. I remember a time when you moved from quarterly to monthly data, and you went from like 80 observations to 240, you felt you had a lot of data. Now with surveys, particularly the Cleveland Fed, the ECB does it. Papers are coming in with hundreds of thousands of observations of individual responses, and it makes academics like me really struggle with the budgets to pay for surveys that are this big. So it's a great paper, lots of data. I won't go through, I won't summarize it. It was well explained. Maybe given we're in the press conference room, maybe the bit that's most exciting is the targeted communication prediction and policy advice. So I'll come on to that. But I basically have five big picture thoughts. Let me jump into them. I'll sort of race through because the timing really does go down faster when you're standing up here. So I think the really big one is the endogeneity or not of skin in the game. So as you saw in the presentation, people who plan to buy a house or a car are said to have skin in the game, and then you see they pay more attention. I think that's, again, I don't want to over-egg this, but that's the sort of core part of it. But we also know that, if somebody pays attention to monetary policy and they understand, for example, that interest rates are going to stay low for a long time, or they understand that actually liftoff might take place in the next 6 months, you might bring forward decisions like purchasing a house, particularly in somewhere like the US, where you can then fix for 30 years. I say this as somebody who has a mortgage on a 5-year fix when interest rates were low, but it's about to come to an end, and now I'm going to have to remortgage at a much more prohibitive level for my consumption patterns. So I'd love to see way more discussion in the paper, not just about instrumenting for a supply of news, which I fully buy. I think it's a good measure, but also to talk a little bit about what drives that skin in the game stuff and really convince me that we are not looking at completely different sets of people. And we know from existing literature, financial sophistication, wealth, all sorts of things could matter for how you pay attention. I should say, the point of 50%, that as the sort of highest bound for attention to monetary policy, it's not that bad. I did something on fiscal where it was 50% paid attention to the UK budget on budget day. And in the same thing, this was actually, it was the update. It was a spring update, so maybe that's fine. But it was like 2 weeks after the sort of attacks on Iran and that whole stuff kicking off, and a third of people claimed they had heard no news about war in that. Some people just live wonderful lives with their heads in the sand. I sometimes wish I could become part of them, so don't worry about that. I tried to link to some of the other parts of this conference. So systematic monetary policy was our first session. And so, in the paper, and I know you do this for convenience, but, this R is just an IID variable that sort of bounces around. But in practice, it's systematic. So even if I don't pay attention to everything the Fed says, if you show me what the data looks like, I could probably guess where interest rates are going. So if I understood this, that could matter. And so the stuff I have with Alistair and Andy from a couple of years ago does talk about, it's not just about explanation and engagement, but also education and understanding. And I couldn't help but show this because it's one of my favorite recent results in my work with Ryan Rolls and Peter Rickards. We asked a question, a sort of a vignette type question, and it was US responses. They get told, and this is one example, but they have mixed signs in other ones, but inflation goes up and unemployment declines. What do you think the Federal Reserve would do with interest rates? So as a sort of guess, in your head, I won't ask you to show hands. How many people do you think get the reaction function right? These are normal people. I don't mean people like us. Well, here's the answer. About 2/3 of people know which direction interest rates will go in if you give them fairly straightforward directional guidance on what's happened macro variables. That blew my mind. My prior was, if we get anything above 30%, I'll be delighted. So people seem to know it well. We then did a follow-up with the same group of people, including the people who got it right, and we show them a kind of Fed open market statement, but we removed the actual decision, and we asked them, based on reading that, could they understand how many could predict right? And remember, 2/3 of them know directionally, sort of qualitatively, what the right reaction function is. Well, if you show them the Fed statement, they do worse than random guessing. So this is going to be a part of my last comment about communication. You're talking about targeted communication. At the moment, the way the Fed statement is written, people who even understand directly the reaction function cannot extract the signal about monetary policy. So I think one thing that you also could talk about a bit in the paper is the role of media in doing a lot of this work for you. I'm now giving you the persona of the entire Fed. Okay, in the model, I think the key reaction to the model is people change. So you talk about like people with skin in the game and people without skin in the game. But of course, I said some updated slides. I had better examples there. If I buy the car that I wanted because I now know interest rates will be low for a long time, I cease to be a skin in the game new car person. After I buy the house, I may become different. The other thing that I think you don't talk about in the paper that I think has as much validity is it matters if I care about interest rates because I'm a saver. You think about purchasing, and it's useful because you have that question, but savers should also have this effect. But I think the takeaway I would have, and I had this written a bit differently, but I think central banks always have to talk, and they can't really target. I don't think they communicate very well with the general public as a starting point. So the idea of trying to target it, to me, seems like a bit too far. You're going to always have a baseline measure of getting through to people. Sometimes the people will pay attention because they're interested in buying stuff, and sometimes they won't. But that targeting is going to be incredibly difficult. I'd love to see you try to address that. On the measurement point, you call it the first direct measure. I kind of don't mind that fully, but you are mixing up things, right? There's an element of demand, the kappa in the model. There's also supply, but there's also this issue of recall. We know that I would bet those people in my survey had heard news about war, but for whatever reason, they just hadn't internalized it. And so there's a mix of things that go on when you ask someone, did you hear news about this in the last week? Maybe somebody interprets war differently. Have you heard any news about monetary policy of the Federal Reserve in the last week? Maybe they say no, but they heard a load of news about interest rates. That's again down to a lack of knowledge of who sets interest rates. This is an issue. And just on the direct measure, this is a really pernickety point, but the people doing like experimental measures, I know you have this sort of large survey measure, they actually try to get attention measures by whether you click on the right button, whether you read this extra section. And they seem like very direct demand measures for information. Like there's a button that says, do you want more information? And they click, I want more information. That's very direct. You have this sort of mix of them. I think it's a great measure, but you may overstate the direct measure element of it. I've got 141. I want to finish. People often advertise their job market candidates. I'm going to advertise a former job market candidate because Alistair Macaulay, who was a student in Oxford and was on the market a number of years ago, he has a couple of papers that look at exactly this issue, and I just to advertise them so that the wider world can see them. He even uses the term skin in the game in the first published one, but he's also done, and actually what's really interesting is in the AJ macro paper, he focuses specifically on the issue of saving. He talks a little bit about borrowing, but he looks at the saving example. And in the saving example, he's able to look at the distribution of paying attention to market interest rates that are on offer. So again, in the intermediation issue, I may not pay attention to the Federal Reserve, but I may listen to my bank about what's happening to interest rates. So they're intermediating what might be done. I think, anyway. Let me just stop. This is a great paper. It's a huge data set. I don't want to make it sound like I don't find the results compelling, because I do. And I think it's great that people think about how we get people to pay attention. And I look forward to what comes next. Thank you.
Okay, Ina, do you want to take a moment to respond?
I can answer a few, or just comment on a few comments. So I do agree with you that the way that the survey question is formulated, it does seem like it would attract both demand and supply parts of attention. I think that it's very striking, however, that we see that huge disparity between what we call, consumers with skin in the game and the ones without skin in the game. If this was a purely supply of news story and not demand about figuring out more or trying to learn more about monetary policy. One thing that I want to clarify is that we do not, unfortunately, this is not a panel of consumers, right? So we just look at the cross-section of consumers day after day. And so we think of this, measure of the skin in the game as really being an individual identifier. Everything goes through, if you throw all sorts of demographic controls in, so it's not that the consumers that have high skin in the game, they're exactly the same types of consumers that have very high income, that are very educated, etc. Right? So the skin in the game is a completely different, it seems, demographic factor than all of the usual suspects. Regarding the systematic monetary policy, so on the model front, initially going with the real interest rate was really more of a convenience because we didn't need to make any assumptions about a Taylor rule or how inflation expectations move. So we thought, okay, the easiest way to think about this is to just focus on the real interest rate, which is almost like the net effect of policy changes that embeds both the nominal interest rate and inflation expectations. We can relax the IID assumption behind it for sure. That will give us some I don't think that the results would change much, but maybe we can talk a little bit more about dynamics and all of that. Fair point on the endogeneity of the skin in the game. These are, the way that we're measuring it is plans about making big ticket purchase, right? So these people, they have not, these are not reported purchases. These are plans of a future potential purchase. And we do find, I didn't mention it here, it's in the draft, but similar results apply when you're measuring the skin in the game with plans of making these purchases 1 year out with just smaller effects, which is, again, very consistent. I don't need to be that attentive to monetary policy now for a decision that I'll be making 1 year out, but qualitatively the same findings apply. And then thanks for bringing up Alistair's papers. So, and maybe we missed that he had the same expression, skin in the game, in his earlier paper, but yeah. And then we can chat later for the rest of the comments. So.
Okay, thanks a lot. Then we can take a couple of questions here, a few to start off with.
Thank you. Bence Bardozzi, Fed Board. So I was thinking about how at the individual level the results make a lot of sense to me. How if I'm about to make a big purchase, then I really pay attention to the interest rate. But doesn't that have a bit perverse implications for aggregate attention changing over the business cycle, as in, if I extrapolate correctly from your framework, then in a big recession where fewer people want to buy cars and houses, there's not that much demand for information from the central bank, and then we should put even less effort on press conferences and such. But I think the opposite happens, no? That we think it's particularly important to talk to people and reassure them that the world is not going to end, and we are aware of things going on. Maybe that's not the implication, but there's the extensive margin of just being a buyer or a prospective buyer for these big ticket items.
Rafet behind.
Rafet Gürkaynak, Bilkent. Nice presentation and discussion. Thank you both. One, maybe this is in the paper, but not in the presentation, but this touches on a whole bunch of strands of the literature, including Ricardo Reese's work on information stickiness. Right? It really is an application of that idea that people don't always pay attention and they're stuck in the past. But also things like, and this relates to Michael's discussion too. Chris Carroll had a bit of the literature on the epidemiological approach to stuff that only when newspapers receive some bits of the information, it becomes widely dispersed. But also Greenspan's definition of price stability too, that prices are stable when people are no longer paying attention to this. And in that regard, maybe this is not totally undesirable, that you have a competent central bank doing its job well and people don't worry about such things. And these are things I think worth thinking about a little bit. The question I have is, again, based on Michael's discussion, it's not very clear that these things are properly exogenous. In particular, my decision to buy a house depends on what I think the financing conditions are. Right? So I'll begin to look for a house and be in your skin in the game set, at least in part, depending on what I think interest rates are doing. And so that's an issue. And one thing that might be feasible, and there's a lot of work on this regard, is you would want to do a information treatment to these people to see whether it's having the skin in the game and hence getting the information, or just getting the information does it for you, right? That kind of answers whether there is a selection bias here. So if you just gave the same information to some of the people who didn't seek this out and saw that they have similar behavior, then this question about, is it endogenous, is there a selection bias, that answers that in a satisfactory way. Thank you.
Could you pass the mic?
Yes. Thanks. Seb Graves, University of Cambridge. So this is a question about the way the question was framed in the survey. It seems like you're assuming in some sense that when someone has heard about the Fed in the news, they've heard about the Fed because of monetary policy. In the last sort of 18 months or so, I guess people are hearing about the Fed for other reasons. And have you thought about the impact that might have on the sort of empirics that you're doing?
Then, could you pass behind you? Yes.
Okay, Gernot Müller, University of Tübingen. So I understand in the end we are concerned about real interest rates for these large purchases. And so I wonder what you really want to learn from monetary policy. So I think it's rather inflation or so, rather than the policy rate. And in the survey, you do have the response of inflation, right, of inflation expectations. So I think it would be really important to cross-check whether people who hear about the Fed and they pay attention rationally also have a better, a more accurate view on inflation. So I think that you could easily check.
Anyone else? Okay, then please go ahead.
Okay, so
We have a couple of extra minutes, but there's still 2 on the clock as well.
So, okay, so let me get started with the fact that the skin in the game is probably not entirely, I mean, we're thinking about it as being exogenous, but in reality, of course, you can make a decision to purchase something after you see that it's appropriate. I mean, I would think that in the first moment that the idea crosses your mind that you want to purchase a vehicle or a house for various reasons, that's the first moment that you want to kind of go and see the interest rate environment and whether it makes sense for you to do it, to make the decision now, wait a week, wait a month, wait a year. So, we do take that skin in the game as being exogenous. It is maybe taking a little bit of a leap, but because we're measuring again these plans of, right? It's plans of making a big ticket purchase. It's not actual decision. It's not the actual purchase of a house or a vehicle. We think that there is some scope to interpret that as exogenous for our purposes. A bunch of questions about inflation expectations. So I had it hidden in the appendix. It's actually quite interesting that the evolution of inflation expectations across consumers that are attentive to monetary policy versus the ones that are inattentive is actually pretty similar on average. So they're all, on average, doing equally well or badly at forecasting inflation. That is important because it highlights that it's really the nominal interest rate part of the real interest rate that is of importance here. We also, as a follow-up question to whether they have heard news about monetary policy or the Federal Reserve, we have a couple of sub-questions that tries to get at the idea of what is that they're looking at what types of news about monetary policy or the Federal Reserve are they looking at? And by far and large, it's the interest rates that are the dominant piece of news that they're reading about monetary policy. I must admit, however, that at the end of 2025, there was another, subcategory which was others or forgot, bundled together, that started going up, and I don't want to speculate what they were thinking about. So regarding sticky information, so I think that, the paper relates to all of the discussion. I think that maybe we need to have a more formal discussion in the draft. One thing that I want to highlight here is that the key difference, right, is that here the presence of sticky information or attention or inattention is an optimal choice of consumers, right? So in a world of imperfect information, when it's costly to go read news, and there's many competing news, right? There's news about monetary policy, but there's also news about, I don't know, the World Cup or anything else, right? So it's costly to, and hence you make an optimal decision to be attentive to monetary policy. In the communication analysis, we kind of take the stand there that maybe communication does not affect the skin in the game. It's a fair point. It could affect, and it might be extremely important during recessionary periods, as you mentioned. But again, taking the skin in the game as an exogenous, these plans of making big ticket purchases as an exogenous characterization of the individuals, the implication is that you want to go after individuals that are willing to, that optimally, right, choose to be attentive to you, because if they don't, they face a lot of welfare losses. And I think that there's other things that I didn't have time to address, but I'll meet with each one of you individually and we can chat more. Thank you so much.
We have a coffee break to discuss more these papers. Let's give a big thank to everyone on the panel.